Making investments in a down economy. We're almost halfway into 2023, and while inflation has slowed, high interest rates continue to be a problem that slows the economy and hampers industry. While this climate may be helpful in reducing inflation, it is to our detriment that it exists. Companies' bottom lines suffer and share prices tend to decline when investors like us search for methods to increase our wealth through compounding. Charlie Munger and others have recently said that investors should learn to live with lower returns. However, one of Charlie's closest friends, Monish, recently gave a talk explaining how investors can take advantage of the current economic climate to their financial benefit. He named his plan "circling the wagons," which is an interesting term. Welcome to Financial Fortune, the channel where we uncover the secrets of successful investing and provide you with the knowledge to make informed financial decisions. In today's thought-provoking video, we dive deep into the question that has been on every investor's mind: is this actually the best investing approach available? Join us as we explore different investment strategies, dissect their pros and cons, and challenge conventional wisdom. Get ready to gain a fresh perspective on investing that could transform your financial future. This is Financial Fortune. Gathering around the flag.
Some of you might have seen Yellowstone, the series. Who's seen Yellowstone? We've got a few Yellowstone fans. I think I was watching the 1889 or something, the second, 1883, right, the second one. And, they're heading west, and there's one particular scene when the Native Americans are attacking, and then they say, circle the wagons, right? I mean, you guys might not remember that, but there's a particular point in which they actually circle the wagons. And circle the wagons actually is a term that comes from the 19th century. And we had these large wagon trails going west, claiming land and conquering the frontier, if you will. And when the Native Americans attacked, the best defensive posture was to put the wagons in a circle and then try to defend as best as you can with that configuration. And I thought that analogy might be a good way to think about investing.
The parallel isn't the clearest, but once you hear it, everything makes sense. Manish puts it this way: as an investor, you want the 5 or 6 big wagons that bring in consistent returns. Finding the 5 or 6 businesses you can hang on to for life, that continue to compound through the decades, and finally shield your portfolio from literally all the other lousy transactions you make, is the best defense, or what he's talking about. This is something that happens frequently yet is overlooked by the majority of investors. I'm not one to exaggerate on a regular basis, however. It is the fundamental reason why the most successful investors are so successful. Even Warren Buffett has, throughout the years, focused on a small number of strategies that have accounted for the vast majority of Berkshire's performance and shielded the company from his many less than stellar choices.
This year, in Buffett's letter, he had a couple of very candid and great quotes. He said, over the years I've made many mistakes, and our extensive collection of businesses consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. So actually, if you look at the 80 plus acquisitions that Berkshire has done, Warren and Charlie probably themselves would acknowledge that probably at least half are outright mistakes. And this is, the best practitioners of the art. And then he goes on to say, in 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. And our satisfactory results have been the product of about a dozen truly great decisions.
Warren Buffett, arguably the best investor in history, claims that the vast majority of the choices he has made for Berkshire Hathaway since 1965, when he first purchased the company, have been poor ones, and that the difference between Berkshire's success and failure is the performance of just 12 big winners, or wagons.
So I tried to basically look at this period from like 65 to 22. And so, you have, let's say, 80 acquisitions in this 58-year period. he probably bought at least 210 stocks. I use 210 for my convenience, so I get to a round number. I like to work with round numbers, but it's probably a larger number than 210. And his key hires, I'm expecting that in the last 58 years, he had at least 10 key hires, which were very important to Berkshire. So if you look at these decisions, there's about 300 important decisions. And he's saying that 12 move the needle.
Investments like Geico, Coca-Cola, American Express, Apple, the hiring of National Indemnity, and so on, according to Monish, are largely responsible for Berkshire's current success. But then what's the takeaway? The fact that finding just 4 or 5 genuinely strong long-term compounders is all you need to perform extremely well as an investor. Don't waste any more time and start looking for such businesses. Keep your eyes peeled for a lengthy runway, strong management, a good return on capital, and a secure competitive advantage. The other, equally vital lesson is to hold on to them at all costs. Please don't trim the roses. Many people who invest in real estate say this. They will tell you that selling real estate was the only time they made a mistake. In the stock market, though, the situation is same. As a species, we have a tendency to be extremely short-sighted, which often leads us to invest our windfalls immediately instead of waiting for them to grow. According to Monish, this is a major flaw, and we should cling to whatever profitable enterprises we come across. Know of the state of the economy, we should be able to sit back and enjoy the ride if the firm is sound, is well managed, has a wide competitive moat, and has been compounding.
I took a stab at what the 12 businesses might be. And what was really important, if you go back to these decisions, the important thing was not that they bought these 12 or they hired a Jeet. The important thing was they kept them all. So it wasn't the buy that was, because they had, 288 mediocre to poor decisions. They kept those two, right? So basically, in effect, they kept all 300. They lived with all 300 decisions. And it was really important for these 12 not to have been deleted or sold. So basically, when we look at this kind of statistic, what we find is that investing is a very forgiving business. But it is forgiving if you don't cut the flowers and you don't water the weeds.
In the case of Berkshire Hathaway, taking into account the 4% of judgments that were excellent and the 96% that were adequate, the average annual return was 19.8%, compared to 9.9% for the S&P 500, for a return of 200%. So, it proves that we shouldn't try to perform any fancy footwork to make ends meet in the current economic climate, even if it may appear difficult to do so. Instead, we need to zero in on whether or not any of these enterprises with the potential for long-term compounding are being offered at fair rates. Keep in mind that large sums of money are always focused on the short term and hence the market. As a result of their collective selling, stock prices across the board have dropped, prompting the question, does this give us with any long-term possibilities in fantastic companies? And the answer is typically yes, especially in times of economic downturn. So, we must filter out the noise, stock up on reliable compounders, and get ready to hang on to them for the foreseeable future. Even if you haven't made up your mind yet, you may be leaning towards swing trading, options wagers, or some other form of speculation. Incredible victory for Naspers and Tencent. Fortunately, Monish provides some case studies to illustrate how effective this circling the wagons tactic can be. Not unexpectedly, his first company is called Naspers.
I want to go over a few other examples because I want to show that it wasn't that Warren and Charlie were anomalies here. I think Warren and Charlie are more kind of par for the course in terms of how things work. So many of you may be familiar, there's a South African company called Naspers, and Naspers used to be a newspaper publisher. And they've been around for about 100 years. And in 1999 or 1998, they brought in a hired gun CEO, Koos Becker. And when they brought in Koos Becker. Basically, at that time, Naspers had a $500 million market cap. And Koos in 2001 took $32 million of that and bought an obscure Chinese company called Tencent. And he got a 46% stake, 46.5% stake in Tencent for the $32 million. When Tencent went public, the value of Tencent was about $900 million at the IPO. And so the Naspers share was almost like north of 400 million, which would have been most of the value of the company. You know, the company was about 500 million. It was now approaching like half the value. They sold a little bit of a few shares at the IPO, but they pretty much did nothing after that. So from 2004 to 2018, they never sold a single share of Tencent. And if you look at it in 2018, Tencent has a market cap of 530 billion. So it went from 900 million, 10 billion, 50 billion, 100 billion, and they're not touching it. At this point, you know, when Tencent is a $100 billion market cap, it's like 99% of the value of Naspers is sitting in Tencent. You know, it's basically almost the whole thing, and it's sitting in a company that they do not control. And it's sitting in a company that is in China. And through all of that, Koos Becker doesn't sell.
Naspers, a South African newspaper publisher, required only one good investment, Tencent, to make everything else it did unimportant. All they had to do was resist the impulse to snip the flowers and monishes. And innocent. As an investor, he recognizes how challenging this is. It's challenging to resist accepting a satisfactory outcome in the pursuit of a spectacular one. However, it's frequently best to just let firms be rather than believing you have to sell them if they're compounding well under solid management, and preserving a high return on investor capital without taking enormous risks.
And again, the important thing was not that they invested in Tencent, you know, because they invested in many other things. The important thing was that they didn't touch it. And even today, in 2023, Naspers is the largest shareholder of Tencent. And on a per share basis, so if you look at each Naspers or Prosus share, their look-through ownership of Tencent has only gone up. So even as they sold, the look-through ownership per share has gone up because they've done buybacks. And again, the circling the wagons around Tencent was really key.
And that concludes our insightful exploration of the best investing approach that is available. We hope this video has provided you with valuable insights and a renewed perspective on your investment strategy. Remember to like, subscribe, and hit the notification bell to stay updated with our latest videos. At Financial Fortune, we're dedicated to empowering you with knowledge and guiding you on your financial journey. Thank you for joining us today. Until next time, may your investment choices lead you to lasting prosperity. This is Financial Fortune, signing off.